So guys, as you probably already know at this point, Starbucks came out with some pretty big news yesterday that had a tremendous impact on the share price. The company announced that their CEO, Laxman Narasimhan, would be stepping down immediately after only being with Starbucks for a year and some change. Now, personally speaking, I think this was a bit shocking. I was not expecting to see a change in batter so abruptly. Although with activist investors like Elliott Management recently taking a stake in Starbucks, there have been whispers about negotiations pertaining to Laxman's role in the company happening behind the scenes. And it looked like there was potentially some agreement that would allow him to stay on board, but apparently that didn't pan out. So with that said, who is now stepping in to be the new CEO of Starbucks? Well, that's going to be a guy named Brian Niccol, who has made quite a name for himself as the CEO of Chipotle. He's actually leaving Chipotle to come to Starbucks. And as a lot of you guys know, these two right here are like some of my favorite restaurants. I love my Starbucks. I love my Chipotle. And under Niccol's leadership, Chipotle's stock absolutely soared, going from about $6.50 at the time he took over in March of 2018 to now being over $50 per share, which is obviously a fantastic return. And judging from the stock's performance as I'm recording this, the market is reacting very negatively to his departure from Chipotle, which could signal that Chipotle is losing a strong leader, while Starbucks' crazy rise in share price, which we'll take a look at in just a moment, could be a sign of the potential that this new CEO brings to the company. Now, before his time at Chipotle, Niccol was the chief executive of Taco Bell and held leadership roles at Pizza Hut, both of which are owned by Yum Brands, and that's actually another stock that I really like. Right now, Yum is on my watch list, and there seems to be a lot of good stuff going on with that company. You guys should give it a look. But anyway, given his extensive experience in the restaurant industry, this guy seems like a fitting candidate to take the reins of Starbucks, and that might have been one of the things that was missing from the former CEO. With that said, we really don't have any details on what exactly went down behind the scenes to ultimately lead Starbucks to take this action. But in a recent interview, Starbucks' chair, Melody Hobson, clarified that the decision to replace Narasimhan wasn't based on a single disappointing quarter. So I would be interested to know what else happened. And with that, she also mentioned that the new CEO will soon unveil his plans for the company moving forward, which will also be interesting to see. Overall, there's still a lot of information that we need to get, but what we do know is that Niccol has very relevant experience for this new job. So hopefully he does a good job. We'll see what happens. At any rate, like I said earlier, this news had a really big impact on Starbucks' share price. Taking a look at this over here on Seeking Alpha, just today as this news was released, Starbucks saw a gain of 24.5%, which, as we saw a few moments ago, is the exact opposite of Chipotle. But anyway, looking at the performance over the last 30 days, Starbucks is officially up about 30% in this time period, so that's really solid. If we zoom out, looking at the year-to-date performance, this is going to leave Starbucks now basically break even. In 2024, they're down 0.1%. Definitely better today than it was yesterday. And if we zoom out once more over the last year, this isn't updated yet, but we could see that 365 days ago, back in August 14th, 2023, Starbucks was just over $101 per share. So they are down just a little bit, maybe about 5% or so in the last 365 days. Now, taking a look at my Starbucks position here over on my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to download this spreadsheet in the description of the video. Here we can see I have just over 78 shares of Starbucks at an average cost of $86.34, which means that after this jump, guys, the share price at about $96 per share, I am back in black on my Starbucks position. If we look at the returns, just looking at the share price returns, I'm up over 11%. On a total return basis, including dividends, I'm up 14.5%, and this jump has made Starbucks far and away the largest position in my portfolio. Right now, it makes up 11.6% of the total weighting. And I've got to say, I am just so glad that I loaded the boat on this stock these last few months. Since the beginning of May, I added nearly 25 shares to my position, with all but one of those tranches happening under $80 per share, which is great. Now, while I'm definitely happy to see this positive momentum, and while I do think all of this CEO stuff has potential to be good for Starbucks, I still can't help but think that such a crazy jump in share price from the news is a bit of an overreaction, and I'm a bit concerned with the sustainability of this surge. After all, the stock only jumped because of this change in CEOs, which, hopefully will be a good thing for the company, but aside from that, nothing else at all changed about the company between yesterday and today. And what I keep thinking about is, did that initial drop in share price that we saw earlier this year, that big plummet, did that only happen because of the CEO? I don't think so. Sure, there was that one rough interview with Jim Cramer after the second quarter earnings release, but outside of that, I think the challenges that this company has been facing this year run deeper than any one person at the top. In my opinion, one of the biggest issues that has been plaguing Starbucks is consumer sentiment, which is not specific to Starbucks, by the way. A lot of restaurant companies have been facing this same issue. We've talked about this quite a bit on the channel, but things are getting more expensive and people are becoming more cautious about how they spend their money, particularly on discretionary items like dining out. And this is just part of the natural ebb and flow of the economy. There are good times where people, will spend a bit more freely, but then there are other times, kind of like what I think we're heading into right now, where people feel like they need to be a bit more defensive with their spending. And as a discretionary company, Starbucks is bound to see some customers cut back a bit on the frequency of their visits if they're trying to better manage their budgets. And that's what we're seeing play out here in the company's financials. Looking at their comparable sales, which measure the performance of existing stores by comparing their recent revenue to the same period last year, this has been declining over the past couple of quarters. I mean, in North America, comp sales were down 2 to 3% each quarter. Internationally, the situation is even worse, with comp sales down 6 to 7%. And China in particular has seen a very sharp decline, with a 14% drop in comparable sales in the most recent quarter. At any rate, these numbers suggest that while Starbucks is far from going out of business, people still aren't visiting as frequently as they did maybe this time last year. And I think that's more a reflection of the broader economic environment than anything having to do specifically with the CEO. And that's not me defending him necessarily. I'm just trying to say that I don't think the news about the CEO warrants a 24.5% jump in share price. Anyway, another significant concern that has impacted comparable sales is the issue of service speed. Starbucks has been struggling to get drinks out in a timely manner, so much so that some customers have abandoned their mobile orders while waiting to pick them up in the store. Fortunately, though, Starbucks has been making strides in this area. If we look at my notes from their most recent earnings release, stores in the top 2 operational performance quartiles saw a huge 28% improvement in service speed from the previous quarter, and a lot of these improvements came from the introduction of phase 1 of the Siren Craft systems, which include new roles, increased partner hours, and a more streamlined prep process. These changes have already been rolled out in about 1,200 stores and are showing really positive results, and from here, Starbucks plans to fully implement this new Siren system across all US company-operated stores. And they're also working on upgrading their espresso machines, which they say could speed things up by around 15% without compromising quality. So I think that's good, but with that said, as a shareholder, there are still some other concerns that are on my radar that pertain to the company's financials. First and foremost, looking at some of Starbucks' profitability metrics over here on SnapStock, which actually is a new stock analysis software that I've been working on these last couple of months, guys. It's kind of been a little secret project, and it's not out yet. I'm going to be rolling out SnapStock officially sometime in the next couple of months. I'm not 100% sure exactly when I'll do that, but if you want to be in the loop and be first in line to receive any information on SnapStock's release, then sign up to the waitlist. I have it linked in the description of the video as well as in the pinned comment. But anyway, taking a look at some of these profitability metrics here, namely the gross profit margin and the net income margin, more so the gross profit margin, but I feel like both of these are ever so slightly trickling down over time. Starting with the gross profit margin, going back to 2014 to 2018, the gross profit margin was over 30% very consistently. But since about then, it started to make its way back down, and now in recent years, we're looking more like mid 20% range, even below 25% in the trailing 12 months. So over time, it does seem to me that this is sloping down, and that is something I'd prefer not to see. I'd prefer to see it doing the opposite. And we see that a little bit in the net income margin. I think it's a bit more prevalent in the gross profit margin, but I mean, 10 years ago, the net income margin, we were looking at, 12.5%, 14.4%, 13%. So, it was like low teens. But then fast forward to now, I mean, in recent years, it's, 10%, 11.5%. So we're kind of still getting those low teens, but it's, this is still a few percentage points lower than what we were getting 8, 9, 10 years ago. So this is something I'm keeping an eye on. But anyway, now looking at some of the dividend metrics here, I mean, historically, Starbucks has been a dividend growth monster, guys. I mean, their 10-year dividend growth CAGR is 16.64%, and this chart is exactly what you want to see, right? But if we make our way over to this chart here, we can see very clearly that the dividend growth has certainly slowed down for Starbucks in recent years. 2014 to 2018, almost every year except for 2015. I mean, it's if we're rounding up, it's there, but pretty much every year we saw 20% dividend growth, and 2019 to now, it's not been that at all. I mean, it's still really good, don't get me wrong, 14.4%. Even in 2020, they raised it by near 14%. But then, once we hit 2021, we're starting to get into single digit raises. But this is still nice, almost 10% here, just above 9%, we'll take it. And then, last year, just above 8%. So it's definitely not bad. Like, I'm not going to stick my nose up at an 8% dividend raise. But you definitely notice the dividend growth going down. And I will be interested to see kind of where this levels out, because if it does continue to, trend how it has been, I do think that would be not the best. Another thing I'm keeping an eye on here in the dividend stats is the payout ratio, guys. I mean, 10 years ago, it was really good, 38%, almost 34%, very low payout ratios all across the board, which is no surprise. You could expect to see payout ratios this low when the dividend growth rates were 20% and above. That's pretty typical. But then fast forward in recent years, it's trickled up, guys. We're now touching 50% in 2021, 2022, close to 70%. Last year, 2023, just below 60%. And in the trailing 12 months, we're looking 62.5%. So overall, that payout ratio has definitely gone up over the years. And that's just another thing you'll want to keep an eye on. And with all of that said, none of this is the end of the world, and it's really not all bad. There is still a lot of good to be found in this company's financials. For example, if we take a look at the growth metrics, Starbucks is still growing very consistently in all departments. The revenue is growing very nicely, as we can see from the chart. The earnings per share, 2020 aside, is still growing very nicely. And the free cash flow per share has been growing as well, albeit not at the same rate as revenue and earnings, but, still looking good. And if we scroll down looking at the return on invested capital, pretty much every year over the last decade, with the exception of 2020, the return on invested capital has been fantastic. In every case, it's been above 20%. And real quick, in case you're not familiar with the return on invested capital, this basically measures how efficiently a company uses its capital to generate profits. And Starbucks' strong return on invested capital is a really positive sign for the company's continued growth. All things considered, guys, Starbucks still has some stuff going on with it that I think all investors should keep an eye on, but I'm still holding strong with it. At the end of the day, this is still one of my favorite companies, but with this recent jump in share price, I'm going to be hitting the pause button on adding any more shares for the time being. But in this next video right over here, I'm telling you about 3 dividend stocks that I will absolutely be buying if the market takes another dip again like it did this last week. If we see things in the stock market really head south in a more meaningful and more lasting way, these are the 3 stocks that I will be prioritizing. I will be loading the boat on these. So click right over here to check these out, and I'll see you in the next one.